Thanks. My name's Andre Liebenberg, and I'm here to talk about Yellowcake. Yellowcake was established to provide pure exposure to the uranium commodity. There are a number of factors which are coming together which we believe make uranium an interesting investment opportunity right now. Firstly, there has been steady and visible demand growth on the reactor side. The extended period of low prices we have witnessed ever since the Fukushima event, which next month is 9 years ago, has meant that there has been a lot of underinvestment in future capacity. And also a consequence of the low prices is that the big producers have made quite substantial production cuts. Against this backdrop, Yellowcake was established to buy and hold physical uranium. We have a very important contract with Kazatomprom, which gives us ability to source material at the spot price. Being a physical holder of uranium, we don't have any operating risks associated with mining, processing, geology, etc. And we've established a low-cost structure such that there is a minimal drag on the equity investment. So Yellowcake, we believe is a mechanism to provide pure exposure to the uranium spot price. Just quickly, we have three key contracts. I briefly spoke about or mentioned the Kazatomprom contract. That allows us to buy up to $100 million of uranium per annum at our option. So we can do all of it or none of it or in multiple tranches. The price setting mechanism is the spot price. So there are two price reporting entities, and the price at which we purchase is the average of those two prices. So we can fix a volume and a price before we come to market to raise the equity. We have a very favorable storage contract with Cameco. We store our product at their facility just outside of Toronto. There are essentially three storage facilities in the West, one in France, one in the US, and one in Canada, where you can store physical uranium. And then thirdly, we have a contract with 308 Services, which really manages our outsourced transactional activities in terms of storage management, the contract with Kazatomprom, and other purchases. Just briefly, our history. We IPO'd in July 2018. We raised $200 million, listed on the London AIM market. We spent $170 million on the initial purchase of uranium. The price at which we purchased the uranium was $21.01. We made a top-up purchase in August, and then in April last year, we raised more equity, $34 million, and made another purchase of 1.17 million pounds of uranium. So to date, we have purchased a total of 9.6 million pounds of uranium, and at an all-in price of $21.68 against the current spot price of $24.50. Earlier this year and in the back end of last year, we saw our shares trading at quite a significant discount to net asset value. So we instituted a very small share buyback, really as a means of buying uranium at a discount to the spot price, because the funds we have won't really make a big difference to the gap. Okay, let me talk a bit about the market. Yellowcake was established to take advantage of a number of factors which we think are coming together right now to make this an interesting opportunity for uranium. It's been 9 years, as I mentioned, since the Fukushima event, and in 2018, for the first time, we saw electricity generation from nuclear exceed the pre-Fukushima levels. And most of that growth has come from the Asian region. So in 2018, the growth in nuclear in Asia was 12%. Last year, China's electricity generation increased by 18%, 8% of increase in nuclear. We've also seen growth in India and the Middle East, and then also Japan. Japan has been a story since Fukushima, and we've seen a number of restarts happening there. They have a policy of having between 20 and 22% of their generation from nuclear in order to diversify their energy sources, because all their energy is imported. They currently have 9 operating reactors with another 6 sanctioned at the national level to restart, but they're going through local processes. In order to meet that 20 to 22% nuclear generation target, they will probably need around 26 reactors burning about 12 million pounds of uranium. But as I mentioned, the real growth story has been in China, Middle East, and India. I mean, China currently has 47 operating reactors. They've got 12 under construction and another 42 planned. Just to put that in context, at the time of Fukushima, China had 13 operating reactors. They plan to grow their fleet, currently consuming about 20 million pounds of uranium, and by 2030 to 35, they'll be consuming 60 million pounds of uranium. The US, which is the biggest consumer of uranium today, consumes about 45 million pounds. So you can see how important China will be. But also India, they have 7 reactors under construction and another 14 planned. The Middle East, UAE have got a 4-reactor program. One's going to come online in the next quarter. And Saudi looks like they will embark on about a 16-reactor program. But let me talk about the supply side. And this is the chart that really plots the uranium price back from 2000. And you can see the run-up in 2007, the fall-off post the financial crisis. Then the price recovered to about $70 a pound, and then Fukushima hit. And basically, since Fukushima, we've had a steady decline in price. We did see mid-18 a slight turnaround, and it's improved. But what is the consequence of those low prices? If you took the production capacity today, about half of production capacity would be loss-making at the current spot price. Now, why are those guys still in business? Because they've got long-term contracts. And those long-term contracts are providing hedges. But I'll mention in a while about what's happening on those contracts. And then, because we've had the low prices, existing producers, seeing contracts rolling off, have cut production. Cameco cut MacArthur River. It's 18% of global production. Kazatomprom, the world's largest producer, in 2017 said they would cut planned production by 20%. So if you look at production in 2017, it was about 160 million pounds. 2018 was 138, and last year was 142. So significant production cuts against consumption of about 170 million pounds. Consequence of low prices, future investment in new capacity has been stalled. And unless those new producers or potential new producers get long-term contracts, they won't get the finance in order to develop the projects. So we do think there will be a supply crunch coming at some point in the future. I spoke about the long-term contracts. If you have a look at the green chart, the green line at the bottom, that's the US coverage on long-term contracts. So in about 2 years, contracts fall off fairly significantly. And those guys need to start contracting about now in order to maintain the necessary inventory. We think the US has probably got about 18 months of inventory. They normally run at about 2 years. If you wait another year, you're down to about 6 months. And these machines have to run. So very simply, and in wrap-up, we believe this is an exciting time for uranium. You've had supply cuts. You've had new supply being pushed out because of low prices. And the Yellowcake vehicle, if you think about it, we're essentially a physically backed ETF in a corporate vehicle. Very simple structure, very low-cost structure, with the intent of providing pure exposure to the uranium commodity. Thank you.